All right, welcome everybody to our session today on Super Reform Package number 2, so Tranche 2, and today we're going to go through the things that you need to understand from Tranche 2 and how they will ultimately relate to your SMSF clients and the planning that needs to be undertaken in the current financial year. So today is very much about exploring the near 200 pages of explanatory memorandum, but then also we will take a look at some of the regulations specifically and then think about contextually what some of the key issues / opportunities actually are within the business as well. So of course what we provide today is general advice only, so please keep that in context from today's session. And of course, what we have provided is our belief as to how these regulations will apply. And do remember that, of course, most of these changes will take effect from 1 July 2017. The only thing now is the catch-up concessional contribution legislation, which will take effect from 1 July 18. We're not covering this today, but the non-concessional announcements, obviously the backdating of the 1 July 2007 is dead and buried, and those reforms will take effect from 1 July 2017 as well. So we have a whole range of new terminology that you are going to have to start to understand as well. So I'm not here to go through what each of these mean. There are some definitions within the explanatory memorandum, but we do need to understand key concepts and the terminology that will apply around these concepts going forward, because we have ceilings introduced into the legislation around the amount that will qualify for an individual to be able to make non-concessional contributions at the $1.6 million, that transfer balance cap amount, and how that also applies in respect to retirement income streams is important. So we have now a obligation or a reason to now have to understand, well, what happens if a member is within the cap versus being above the cap, and how refund mechanisms might work, notional earnings might work, how the different taxation works between those that are under a cap over a cap. But ultimately, today is about trying to make sense of what this all actually means. So we saw last Thursday, I think it was Wednesday, Thursday, the government released for public consultation Tranche 2, which is the exposure draft legislation around a range of key measures here. So the ones that I have in bold are the ones that we're going to focus on today. So predominantly the introduction of the $1.6 million transfer balance cap and transitional arrangements around what people have to do if they already have a balance in excess of $1.6 million paying an income stream to them. We've also seen in this draft, exposure draft, the legislation around the changes to concessional contributions, so the reduction in the cap to $25,000, also the reduction in the threshold, so of the Division 293. The only real thing of substance to note there is around the indexation of the $25,000 amount. Previously, we've seen that go in increments of $5,000 linked to a WATI. That is going to change down to increments in $2,500 blocks. So we are going to see a change in respect to that threshold at a much earlier rate than we may have thought otherwise previously. We've got in this legislation the regulations around catch-up contributions for those with less than $500,000. Again, that has been deferred until 1 July 2018 as a result of the negotiation on the non-concessional contributions. There's some removal of regulatory barriers around creation of retirement income stream products. That doesn't affect self-managed super funds. We are going to spend time on improving the integrity of transition to retirement income streams and some other integrity measures around those, which were somewhat of a surprise. And then, of course, within here, we have the removal of the anti-detriment provision. So again, these all line up with the decision of the government to really set a framework for the superannuation system going forward, and that's this objective of superannuation. And ultimately, when we think about being able to provide and supplement the age pension, and I guess there's still some debate around whether it's a fit for purpose objective, what the government has made very clear, and I think this is the more important piece in the context of many of our SMSFs, is that it is not an estate planning tool, and therefore we have seen these measures come in solely on the basis of getting that position right going forward. So we know when we look at the new requirements around the transfer balance cap that the government is introducing, and we've seen this since budget night, that the new rules, I should say, are going to limit the amount of capital that can be transferred into retirement phase to support a superannuation income stream. That's a critical piece going forward. Whilst conceptually we know what retirement phase means, we're now going to see that definition introduced into the tax laws to cover off the tax exemption as it relates to a superannuation fund. So I will come back to that when we look at the integrity of superannuation rules later on. But just note, one of the very important first things now is the way in which we're going to be defining tax exemption inside a fund is going to be a product of being in retirement phase against someone who is not in retirement phase. So an individual will have a transfer balance cap of $1.6 million that we know is the case for that first year from 1 July 2017, and it will be subject to proportional indexation. So in $100,000 increments that will line up with CPI. So once it moves from 1.6 to 1.7, it doesn't mean that an individual naturally gets that $100,000 available to them. If they have used, say, $800,000 of their transfer balance account, and again, we'll get to this in a minute, effectively, they will only get a 50% uplift of that unused amount. That's what the proportional indexation is looking at. So what's included in this retirement phase concept? Well, it's the value of the superannuation interest that is supporting an income stream that's in existence at 30 June 2017. So we are going to have to look at structuring of income streams as at 30 June 2017 and potentially have that, it looks like, having those reported in the 2016-17 returns. And then also any then commencement of a new income stream that starts from the 1st of July 2017. So in very simple terms, anything under 1.6 will be still exempt from tax, having moved into retirement phase. Anything that's over and above is going to be required to be either taken out of the super system or commuted back into the accumulation phase, where a 15% earnings tax will actually apply. So how is it going to work? And you'll see on the diagram here on the right-hand side, we are going to now have what's called a transfer balance account for every member that moves into retirement phase. So every existing pensioner that continues to have a pension from 1 July next year will have a transfer balance account established on the 1st of July 2017. Someone that moves into pension phase at some point in the future will have a transfer balance account created at the time when ultimately that pension is reported. And it's going to look very much like a normal bank account or a general ledger. So it is going to have ups and downs, and it's going to be measured over time. And it's simply going to have credits and debits applied to it. And we'll go through today what many of those credits and debits actually mean. Interestingly, you can see here, there are circumstances where arrangements will apply where the amount could actually go below zero. And an example of that is where, say, an individual has started a pension inside a retail super fund or an SMSF, and then they've decided to commute and roll that money out, and then are going to start it in a brand new environment. The way the debits will work, and again, we'll come to this shortly, it is effectively going to debit out the market value, so it will allow the individual to replenish the full value that comes back in. So we are going to have reporting obligations for moving in and out of the system. We're also going to have some initial reporting obligations for those existing income streams that are going to move into retirement phase in readiness for the 1st of July next year. If we actually have a breach of the transfer balance cap, so TB cap, transfer balance cap, if an individual breaches that at some point in time, this is where we have a whole new piece of regulations that will operate around excess transfer balance cap amounts. And there will be, similarly, I guess, to how it works for contributions at the moment, in particular non-concessional contributions, we're going to see not only the requirement to commute the amount down, so there will be an obligation under either an authority from the government, from the ATO, I should say, as regulator, or the individual, once they become aware of it, can actually commute it. So it is slightly different to non-concessionals. In that regard, there will be a notional earnings amount applied to that, and then that notional earnings amount would obviously then be attributed to the individual themselves. So again, we have a calculation that looks at that notional earnings, applying, again, very similar things to non-concessionals around the 90-day bank bill rate, plus 7 percentage points over the number of days that actually sit inside that particular year. So if we take a look at an example here, we've got Andrew has a personal transfer balance cap of $1.6 million. He commenced the pension in his fund for $2 million, so he has a $400,000 excess. He finds out that he'd made that mistake, and 30 days later he decides to partially commute that and remove the excess. Now, whether that's rolled back to accumulation or taken out of the fund is irrelevant in the context of this example. So over the course of that 30-day period, he generated notional earnings of about $3,036 that you can see there on the rate as 9.2%, being the bank bill rate plus 7 as it stands at the moment, which then brings his transfer balance account to $2,003,036. So on the basis of that calculated amount and the excess that he has, he needs to determine to pay him a super lump sum of $403,000, and then that is reported as part of the commutation process, and it will then bring him back in line with the $1.6 million. And then also it should be noted that he wouldn't be able to make any further contributions into his retirement phase account anymore, because he will have used 100%. And even if the threshold indexes over time to 1.7, 1.8, he will have used 100% of his cap. So he's actually triggered that 100% proportion and can't take advantage of any of that indexation. So a couple of things we need to understand here. And the first one is that it will be somewhat difficult for us to get that figure absolutely right for our clients that have to peel back, because it's going to require us to do this prior to the 30th of June so that the reported information goes in as being hopefully at the 1.6 or just under at that time. So where we have an existing pension in place, there is going to be a carve out or in respect to how notional earnings may be attributed. If an existing superannuation income stream has an excess amount that's determined at 30 June of being less than under $100,000. So we do the accounts at the end of the year, and through valuations and the like, we thought we got it to 1.6, but what happens is that it ends up being 1.625. So because that amount is under $100,000, as long as it's identified and rectified within 60 days, the Commissioner is happy for that to basically slide, and there'd be no requirement to apply notional earnings in respect to that amount that was above the transfer balance cap. So just remember that we do have that available to us whilst we're trying to get the right number to be reported at the 1st of July 2007. But it's going to need to plan back and look at how you might structure how this ultimately works. Okay, next one is this transfer balance account. So again, it's this concept that I spoke about. We're going to have these pluses and minuses that generally will be credited to an individual on the basis that they enter into post-retirement or retirement phase, but then also come out at certain points where they may do commutations around the death of the member and so forth. So an individual's transfer balance account is generally a lifetime account, and when they go, it goes with them. Now, there are some modifications in the legislation that will effectively allow for this to continue, and predominantly this is happening where a child pension will be paid, where they would ultimately be only entitled to receive that pension until age 25, unless for some reason they continue to be able to receive that as a dependent where maybe they were under a disability. Now, the rationale for this is that when that actually ceases, it will then enable that child to utilise their own transfer balance account when they actually meet retirement. So we're going to cover that further shortly, but what what I'm trying to explain there for you is that every person has their own cap. It's triggered at the point in time where they move assets to post-retirement. And once they're gone, effectively that cap goes with them. And I'll talk about reversionary pensions in a minute. But effectively, the only exception where it may continue is where we need to look at it in respect to a child pension. So I've got a couple of questions here. Kerry, I hope the sound bit's fixed for you. Frank, is it 60 days from the point of finding out the breach? So example 2007 annual return prep. Good question. I'll take that on notice when we come back to maybe the Q&A later. I've got all the information in front of me here. And then Raylene, does that mean we need to report the balance of all member pensions for all funds by the 30th of August 2017? It doesn't make mention in here around what the reporting obligations are going to be, whether these are going to be lined up within the SMSF annual return or whether there's going to be a separate approach to having to report these maybe on a more timely basis until I guess we get to a process of consultation or further consultation. Not only will we see the government obviously consult, or Treasury consult at the moment, but that'll then start to flow down between the regulators and then industry on some of the practical applications of this as well. So let's keep moving. So we've talked about a little bit about the proportional stuff before. I again just want to talk to you about how we need to apply the proportional indexation, and in particular where there may have been a range of transactions actually that go with it. So we had here Nina commenced a pension in October 17 for 1.2, and then what she did after that, not long after, is did a partial commutation and paid a lump sum to her of $400,000. So she had a transfer balance of 1.2 million, and then in January it was down to 800,000 being her transfer balance account. Now, when we get to 2021, there's been an index and the threshold goes up to 1.7. So what the law is going to require us to do is now work out what Nina actually has available to her to be able to make further contributions. And to do this, we need to work out by the amount by which her personal account is indexed, and we need to identify the highest balance in her transfer balance account and what the cap was at that time. So in this instance, because her cap has been as high as 1.2, we have to say effectively that she'd used 75% of it at that time. Or in reverse, she had 25% unused at that time. So on the basis that she had an unused amount of 25,000, she only gets 25% of the uplift in that indexation. So her new transfer balance cap has gone from 1.6 to 1.625. Now we get a few years down further and it's been indexed again to 1.8. She hasn't added anything further to it, so the unused cap still remains at 25. So she now has a transfer balance cap of 1.65 million. She can now start another pension, and it means that she could add in a further $850,000 into the retirement phase, and that would mean that she would take her right up to her transfer balance cap at the $1.65 million. So where we have multiple transactions going through, we do need to look at a highest balance approach in there to help determine what they may actually have left in respect to their transfer balance account. If it starts a pension and it was just 800, then obviously she would have had the additional 50% uplift but because in this instance we needed to look at the highest balance, we do need to adjust for the commutations and stuff that have come out in the transfer balance account, but the higher value when we're looking at what she can tip in going forward. So we spoke earlier about this general ledger or bank account credits and debits to the transfer balance account. So a few things that we need to note here around what are credits to this account. So first of all, the value of all income stream interests that are supporting superannuation income streams in retirement phase on 30 June 17. So we're looking at here again, definitional wise, superannuation interest, nothing changes there. Supporting superannuation income streams, that is a concept we're fairly comfortable with, but have moved into retirement phase. That is a concept that is new in a legislative phrase, but not in a contextual phrase. So we need to get that bit right. The commencement value of any new pensions, including new death benefit income streams, and again, I'll get to that shortly, in retirement phase from 1 July. The value of reversionary income streams at the time an individual becomes entitled to them, and then any notional earnings that accrue on excess transfer balance accounts. So one of the important things you need to note here is that changes to the value of an interest that supports a superannuation income stream after that has been initially reported, we don't need to apply any debits or credits to it. So if we have an increase in earnings, in market valuation of those assets, and the balance of that account, if it started at 1.6 and it grows to $2 or $3 million, that is fine. Those are not credits or anything that need to be added to the account, nor debits if there's a decrease in value. So there is a stake put in the ground that reports the amount that is being purchased or moved into retirement phase, and what happens thereafter from an investment earnings point of view, we don't need to give consideration to. There had been some questions about saying, well, if it goes from 1.6 to 1.7, do we have to move money back out so that the pension member is not getting anything more than 1.6? That's not the case. With the right investment strategy, if they grow it to $10 million, well, effectively, it's good on them. So some other important areas around modifications, and in particular, this one is critical for reversionary income streams. So we have, tax ruling 2013-5 that looks at when a pension commences and ceases, and the pension can ordinarily continue where someone has an automatic entitlement to continue to receive that income stream. Now, we had seen some, differences of opinion in industry how reversionary pensions might have applied going forward. I was in the camp where I hoped that they were going to continue and would effectively remain the interest of the deceased individual until the subsequent beneficiary died. There were others that were saying, no, it won't, it'll be a flat 1.6 and the money's going to have to move out of superannuation. We've actually hit the middle, in some respects, because what's going to happen here is that, yes, a pension can ordinarily continue, but it will become a credit, so a credit transfer to the reversionary beneficiary. So if we have an individual that already has a $1.6 million balance themselves, that reversionary beneficiary, the modification here is going to only give them a period of 6 months following the death of the primary pension member to readjust their benefits down, so the reversionary's benefits down to their $1.6 million cap or whatever their transfer balance cap is at the time. So they've given this 6-month period of grace, obviously, to allow for individuals to understand what needs to happen, go through, the grief of any family member death, but they are going to need to make adjustments and then have that amount reported. And if they don't make those within the appropriate periods of time, we will see a commutation release authority be provided by the ATO to ultimately require that amount to come out. And again, notional earnings and the like applied to them. So let's take a look at this example. John has a reversionary pension worth $1 million at the time of his death. So this, importantly, is a function of the market value of that income stream at the time the member dies. So his wife Heather was nominated as a reversionary to John's pension. Heather's currently in receipt of her own pension and has a balance of that was credited to her transfer balance account for $800,000. So in November 17, Heather is advised that in August she became automatically entitled to John's pension and that she needs to act because the combination of the two is going to now cause her to breach her cap. So she now will have effectively $1.8 million in retirement phase, and she has to reduce that down to 1.6 million on the basis that that was the cap still at that time. So she's got a couple of things that she must do by the 1st of February 2018. So she can either fully commute the pension, she can collapse the pension and move it out of the superannuation system, or she can undertake a partial commutation from one or both of the pensions for the potential excess of $200,000. So she's got those two options. She can't just simply say, well, look, let's just max out a $200,000, let's just pay out a $200,000 pension payment, because pension payments don't count as a debit towards the member's transfer balance account. So we're going to have to structure it out as a commutation, and whether that commutation is to roll back to accumulation or to pay it out of the system, the legislation doesn't worry about that. You can do either of those two. So in this example here, on 1 December 17, Heather makes a partial commutation and receives a super lump sum of $200. It then triggers the debit that she needs and brings that her existing pension down to $600,000. So the $1 million credit is then attributed to Heather, and the reporting can happen up to 6 months thereafter. So I guess there is some benefit there if you could take advantage of that slightly, that window of 6 months, but ultimately that's the maximum period that can apply. And therefore we get to a situation where Heather hasn't breached her transfer balance cap. So estate planning here is going to become critically important when we look at some decisions around the different pensions or benefits, interests that need to be restructured, commuted, taken out, and the like. So this is something that you're going to have to identify with your particular clients, not only looking at clients that may be individually at a $1.6 million in the immediate term, but thinking more broadly now for your clients longer term around some of the estate planning issues and what they might do in the event of their death as well. So debits to the transfer balance account. And what we're seeing here is things like where an individual commutes a superannuation income stream, that ultimately that market value that's determined at the time in respect to paying that commutation will be debited from that member's transfer balance account. A debit will arise for structured settlement payments that are received and then are ultimately contributed into an individual's superannuation interest. So we're looking at personal injury payments there, and a range of other limited events. So these replenishment debits, where an individual may lose some or all of the value of their superannuation, and I'll touch on that shortly. And remember what I said earlier on with one of the diagrams, that we can end up in a situation where an individual may end up with a negative balance for some period of time, or potentially forever when the money comes out of superannuation. So because many of these transactions, when the debits are coming out, are looking at it in a context of its market value at the time of payment, so that if the money comes back in, you're getting like for like replenishment back against the transfer balance cap. Now, getting inundated with questions here. I'm going to keep flying through for the time being, just because we've got so much. I'm happy to hang around and answer these. So keep putting the questions in, because I will answer them, but just acknowledge, I guess, from me that I want to make sure we get through as much of this as we can within the time today. So debits for commutation. A superannuation income stream here may be reduced, like I said, by the commutation of the income stream. And as I stated earlier as well, it can be physically paid out, or the legislation will allow for a commutation to be an amount that is rolled back into accumulation phase out of the retirement phase, and ultimately that the tax earnings would then be subject to tax at 15%. So a debit will apply to the individual's account regardless of whether the commutation is retained in super or paid out. We're going to see the clip actually come off that account, and this may result in circumstances where the debit may exceed, like I said, the balance cap or their transfer balance account. So let's have a look again here at just this example of how the commutation will work. And this more at the moment, we're talking about full commutation here. So on the 1st of July, John purchases a pension for 1.6. On June 18, the SMSF, the super interest supporting the pension has increased in value to 1.7. He decides to commute the pension and roll over the benefits because he's starting a self-managed fund. His transfer balance debits down to 1.7 million for the commutation. So his transfer balance account at this point in time is now minus $100,000. When the rollover hits the self-managed fund and he starts a new pension for 1.7, the amount will be reported against the transfer balance account and will show the assessment against his transfer balance account back to $1.6 million. So that's why we have the reduction down, so that it will allow for this transfer between, I guess, super funds and the like to get money in and out and replenish like for like value. Now, here's where it gets a little bit more interesting, because with partial commutations, whilst they're going to be recognised in exactly the same way, we are going to see some changes around partial commutations and what we currently understand we can do with partial commutations, both in the context of it applying towards a minimum pension payment, but also in respect to being able to make an election under Regulation 995-103. So any partial commutation, like I said, is treated in the same way, with the individual receiving a debit for the value that they receive. Amendments will be made, however, not to allow partial commutations to apply towards an individual's minimum pension for an income year. So we are going to see the removal of Regulation 995-103. So when we look at the determinations SMSF D 2013-2 around electing using the regulation to treat an amount as a lump sum rather than as a pension, the repealing of that legislation is going to not allow for us to be able to make payments that way, which will also mean that any payment that is a commutation won't actually apply towards the minimum as well. So we're going to have to make sure those proratas actually come out in respect to that income stream. So without these amendments, and the reason why they're doing this is that an individual who has reached their transfer balance cap, what they could effectively do is cycle the pension amount every year and use the election to treat it as a lump sum, which then becomes a debit off the cap, and then they top that back up. Because pension payments aren't debits, but commutation payments are, they need to align the two to make sure that there is a consistency in the legislation going forward. So we're seeing some changes in the legislation there in respect to how partial commutations can or can't apply going forward. The one thing here that is going to be very interesting, I myself is going to make a submission around it, is the transfer, the ability to use a partial commutation, I should say, was an opportunity for individuals over the age of 60 in particular, maybe wanted to do a in-specie pension payment. They haven't mentioned that anywhere in the regulations. Most of the focus has been around the tax arbitrage between pension payments versus lump sums for individuals that are under the age of 60. So the full repeal of Reg 995-103 is basically going to knock out any ability to make pension payments in any other way other than cash. So just note that you'd still be able to make a payment by way of lump sum, but would have to follow a commutation and therefore wouldn't qualify towards any minimum pension obligation for the year. Structured settlement debits, these are going to be debits that arise in respect to personal injury payments. So in the form of a structured settlement or an order for a personal injury payment or lump sum workers' compo payout, where ultimately it's been signed off by two legally qualified medical practitioners. There are different rules around whether the arrangement was a pre-May 2006 payment or post 10 May 2006, and I guess the requirements around the amount having to go into superannuation within 90 days of the payment being received or the structured settlement to take effect. What's going to happen here is effectively we'll have a debit and a credit being applied against that individual who has received that structured settlement payment, so that we get this debit and credit, and ultimately that individual still has their transfer balance account naturally available to them. So by way of example here, we've got Alan, 42, was seriously injured in a car accident. He undertook legal proceedings against the driver and was awarded court costs and got a settlement of $4 million due to the severity of his injury. So within the prescribed time frame, he contributed the $4 million into his super fund and immediately commenced a superannuation income stream and notified the commissioner of the contribution. So in that instance, we get both a debit and a credit that arises on the transfer balance account simultaneously. So even though that money's gone into the fund, his balance is still nil, which would give Alan the opportunity to use and build up other retirement benefits that he may have to enable him to ordinarily use his $1.6 million transfer balance cap without having breached it by virtue of the other structured settlement payment that went in there. So that's a good outcome. We've heard the government talk about having a carve out for that for some period of time. We also have a range of other areas where we may be able to replenish debits, and these are certain life events where the individual will be able to apply to the commissioner on a case-by-case basis to have an adjustment made to their transfer balance account. So this is where there may be a court order under a family law payment, where a particular fraudulent activity took place, where we might have a Storm Financial, Trio, Capital One, of those type of things, and any void transactions that may have occurred under the Bankruptcy Act where money has gone into super but effectively has been clawed back. So in these circumstances, again, we can have an individual that's affected by these to notify the commissioner of that specific event and then receive a debit in respect to that transfer balance account. And there's no time frames around those. So it effectively allows individuals to reset, because if they've used a significant portion of their transfer balance account and lost basically a lot of it or all of it, this at least provides them with an ability to replace that due to the losses that they've incurred along the way. So there is a little bit to cover around these replenishment debits. I'll refer you to the explanatory memorandum. I'll put together a bit more information around this at some point in the future, but for today, that's really to the extent that I'm going to cover off on those three issues anyway. So the other area here is then, well, what happens when we get an excess transfer balance determination? So we either get to a point where they're over the 1.6 or maybe initially, or they've triggered a range of contributions to retirement phase where they've gone and haven't worked out that they've actually gone in to excess, maybe because they haven't understood how the proportionate approach worked to I guess credits into retirement phase. So the commissioner here may make an excess transfer balance determination, and as I said earlier, these will apply very similarly to how excess contributions tax, the excess contribution tax regime currently works. So there'll be a determination of an excess amount in their account, transfer balance account, against the cap. Rectification can actually occur, however, here by the individual, so there's not a compulsory obligation to wait for the assessment like there can be with non-concessional contributions. Whilst the commissioner might not issue an excess transfer balance determination, they are still liable for any excess transfer balance. So even though there might be a month or so that goes by, there's still an obligation there to determine what the excess amount is and calculate whatever that notional amount is. So the amount that is excessive is going to be known as the crystallised reduction amount. And it's going to require that amount to be refunded, which will include both the notional and the excess. So if we have a look at an example here, we have a member commences a pension, say in July 17 for $1 million. We get down to October, they've decided to start a second pension for $1 million. So clearly they're over. Within a short period of time, they've identified the issue, they've commuted the amount that's come out. It's been reported the Commissioner issues an excess transfer balance determination that sets out the crystallised reduction amount that needed to be paid out, $401,414, and that can also include a default commutation authority. So it's the mandatory obligation to take that money back out of the retirement phase. And if that authority is issued, then the individual member has 60 days to commute one or more of the income streams. If it's going to be a different income stream to where it was initially added into that breached, it would require an election back to the Commissioner to determine which one that would actually be being reduced from. So again, that just gives you an understanding of how the excess transfer balance and default commutation notice will actually operate. We then get to excess transfer balance tax. So this is how the tax regime will work for those that breach the $1.6 million. So excess transfer balance tax is applied to an individual's accrued amount of notional earnings over a particular financial year. The annualised earnings may relate to multiple periods when the individual has had an excess transfer balance. So the notional earnings are taxable to the individual regardless whether they've rectified their breach and removed the notional earnings out. And the standard rate for excess transfer balance tax is 15%. But if there is any sort of ongoing breaches of this nature, the tax rate moves from 15 to 30%. So it's there to be a detraction for individuals who are potentially thumbing their nose to a $1.6 million concept. So notional earnings will compound daily until such a time that the Commissioner issues that determination to the individual. So let's again just have a look at an example here. Andrew's already reached his transfer balance cap of 1.6 because he's previously started a $2 million pension. But he's commenced a further income stream for $1 million, breaching his cap even further. So 60 days later, we get the Commissioner issues a determination to Andrew identifying a crystallised reduction amount of $101,236. So the $1 million plus 60 days of notional earnings. 65 days after issuing that determination, the Commissioner issues a commutation authority to Andrew's fund saying you must pay this amount back out, and that amount will go down to his accumulation account. So 10 days after issuing the commutation authority, Andrew's fund complies with the determination and makes a partial commutation, paying out both the $1 million and the $15,000 and a bit of notional earnings, and pay that as a lump sum to Andrew. The notional earnings accrue to Andrew during this initial 60-day period before the determination and the subsequent 75-day period before the commutation actually occurs. So when we look at how the calculation of notional earnings applies here, we can see we maybe had an initial 30-day period where his $2 million pension was over the 1.6. We then have the $1 million that was over. We then have a further period of time between when the notice was provided and it was resolved of a further 75 days. So we have $37,000 worth of notional earnings, which get applied at a 15% tax rate. So the calculation of notional earnings and its compounding and the compounding of it daily only applies to the 60 and 30 days amounts. It doesn't apply to the 75-day amount because that period is calculated on a concept of, I guess, simple interest, because the basis for that is that it reflects that notional earnings are not credited to his transfer balance account once the Commissioner has issued the determination. So once the determination has actually happened, the compounding daily calculation actually ceases there, and then effectively that liability transfers across to the individual themselves. The other area that we need to cover off on, and again, this is quite substantial in here and don't have the time to go through this at length today, but there are going to be a separate range of modifications to how the transfer balance cap will apply in respect to certain defined benefit income streams. So we're talking about here more, I guess, public offer funds that are still defined benefit, so CommSupers and the like, but we also do have SMSFs that are still paying defined benefit income streams, say under 1062 or 1064, but the defined benefit income streams here are really capturing non-commutable income streams. So it is market-linked pensions in here as well. And what we're going to have happen here is that there is going to be modifications to how the cap will operate that will effectively define these as cap-defined benefit income streams. And because these can't be commuted, we could have balances when we look at the valuation requirements here that are above $1.6 million. So it's not going to let them roll that back to accumulation, but there's going to be a commensurate approach that works out how the payments need to ultimately be taxed, both in the hands of the individual and then also how it applies within the fund. So again, it's a conversation for another day. If you do have any defined benefit pensions still being paid within SMSFs, also market-linked pensions, there is a valuation approach that needs to happen to determine the market value to test it against the $1.6 million. The market-linked pension, from memory, is the current pension times the remaining term. I can't remember what some of the other ones are, but again, you do need to be aware of the different set of rules that operate around those defined benefit income streams. Now, we spoke earlier about the modifications to child pensions and the fact that there is somewhat of a carryover of the parent's entitlement and how that carries on to a child. So a child recipient that receives a superannuation death benefit from a parent is entitled to a modified transfer balance cap. And this basis is to ensure that they don't exhaust a cap before they reach retirement age. Now, what's going to be interesting here is we need to look at whether this is a pension that is already in existence before 1 July 2017, or is it something that happens thereafter. So if they've started to receive it at a time after the death, but also we have to look at, well, did the individuals themselves actually have a transfer balance cap or account in play at the time that they were at the time of their passing? So there's a couple of things that we need to understand there. In particular, you need to look at the regulations around existing pensions versus those that may be at some point in the future, because there are some different requirements around these. So by way of example here, we're going to look at where we have multiple beneficiaries, like child beneficiaries, and the parent doesn't have a transfer balance account. So maybe someone in their mid-40s, we'll say Emma here is mid-40s, she dies in June 18 with $2 million worth of accumulation interest. Her daughters, Sarah and Chloe, are the sole beneficiaries of her superannuation interest. Emma left clear instructions that the benefits to be shared equally. Now, because Emma hasn't retired, her beneficiaries are entitled to a proportion of the general transfer balance cap, which we assume for the 2017-18 year is going to remain at $1.6 million. So in that instance, Sarah and Chloe will get their proportionate share of the 1.6. So they can each receive an income stream of $800,000, being 50% of the general cap that would have applied to Emma. So the amount that is excessive, so the $200,000 that Sarah and Chloe are going to get, needs to basically be taken out as a lump sum and then cashed out of the superannuation system. So the modification there is going to allow them to receive a pension, but what we need to understand is, well, how many beneficiaries do we have? Was the deceased in pension phase or not at that time? And then if there is a surplus to whatever the proportionate cap that the beneficiaries are to receive, that money must be paid out of the system, because those individuals themselves will be eligible at a future point, because of the modification, to use their own transfer balance cap when they are of an age that they move benefits into a retirement phase account. So we have a situation now where individuals are potentially having to restructure their superannuation arrangements or their pension arrangements because of the $1.6 million transfer balance account. So what is happening is that the government is allowing for a level of CGT relief for individuals acknowledging that the goalposts have effectively moved. So where an individual needs to commute a superannuation income stream to transfer amounts from retirement phase back to accumulation to comply with the cap, the earnings on assets supporting these commuted balances are ultimately going to become taxable. So, and this is also going to be the case with transition to retirement incomes. So the government is introducing CGT relief that is going to allow super funds to reset cost bases on CGT assets that are moved or reapportioned from retirement phase back to accumulation prior to 1 July 2017. Now, this is important because the government has acknowledged that in reality we were going to see a lot of activity happen this year to reset cost bases. So they're now going to allow individuals to, I guess, look at the legislation prospectively. So I guess this is this argument between, are these measures retrospective or prospective? So in essence, there's a free kick that's being provided here to say that they will allow for, in essence, a trigger event for CGT to happen prior to 1 July 2017, and to ensure that tax is only paid on capital gains in the future based on the market value. So think about that in terms of valuations going forward. And it's removing any complications that may have been if individuals are going to be looking at buying and selling shares that may have got caught up in wash sale arrangements that again, the Commissioner has highlighted previously around the application of Part 4A. So when we think of this CGT relief, we've got to look at things like, do we have segregated current pension assets inside the fund at the moment, or do we apply an unsegregated or proportional approach to income streams? Because the CGT relief here is somewhat different between the two. So segregated current pension assets, where a fund ceases to be segregated prior to 1 July 2017, and I'll come and explain a bit more about that in a minute. It may choose to reset the cost base of its asset to its current market value. The choice needs to be completed in the approved form. So there's going to have to be an election done before the 2016-17 tax return is lodged, and it's an irrevocable election. If we assume in this instance that the asset will be sold for its market value at the time the segregation has ceased here to apply, and will simultaneously reacquire that asset inside the fund. So it's a journal entry in essence in respect to what's going on, but requires some very important documentation around that specific decision. So we've got Time or Timmy and Laura. We have them, one's retired, one's in accumulation phase, that have an SMSF which holds a number of segregated pension assets. They're designed for Tim's pension account, which is currently at 2.6. He's got to peel back $1 million back to accumulation, and to give effect to do this, he's moved specific assets with a market value of $1 million out of his existing segregated pool of exempt pension assets. The cost base of those assets is $750,000. Current market value $1 million, cost base $750,000, unrealised difference of $250,000. So to ensure that the capital gains are not taxed when it's eventually sold, the fund chooses to apply the CGT relief arrangements and reset the cost base to $1 million for him. So that's a very important task for you to think about in the current financial year. Where we look at a proportional approach, and the fund uses this unsegregated method, so we're getting an actuarial certificate or the like for this, the fund may choose to reset the cost base of this asset to its market value at 30 June 17. Again, the choice needs to be done in the approved form, and it's irrevocable. The cost base of the asset is reset, and assuming that it's basically sold and reacquired again. So to take advantage here of this reset cost base, the fund will have to dispose of this asset within a 10-year window. So effectively, we've got till 2027 to sell that asset. If you don't sell it, then the original cost base will be reintroduced in respect to that asset. So we've got Claire with a pension national in accumulation. They have a heavy asset concentration inside the fund with a single asset valued at $3 million. it uses a proportional approach to claim those amounts. To comply, Claire partially commutes $500,000 of a super income stream back to accumulation phase. This means that the proportion of fund assets that support Claire's pension is 50%. The cost base for the asset is now $2.5 million, or the cost base was 2.5, meaning there's a $500,000 unrealised gain. The fund then chooses to apply the CGT relief and resets the cost base. Now, the reality of the matter here is that the fund calculates the notional gain because Ashley's in accumulation phase. It would be ordinarily subject to tax, so $167,000. If the discount isn't applied, then you'd need to actually include the net capital gain after adjusting for the 1/3 discount and the like inside the annual return. So again, if you don't apply the deferral, then you would need to include that in this example inside the 2016-17 annual return. Okay, we're nearly there, folks, and I am conscious we're just about to hit the 1 hour mark. So we've got some integrity measures that are also being introduced, and these go to the root of the changes to transition to retirement income streams. So the tax exemption is going to be removed from transition to retirement streams, as much as also we're seeing the regulation 995103 be repealed that will disallow a fund or a member to elect to be able to treat that payment from a TRIS as a lump sum for tax purposes. What was a surprise that we had no, suggestion or hint of was that SMSFs that are looking to use segregation for members that have balances in excess of $1.6 million are going to be prevented from doing so. So this is, I made mention right up front, and I've talked about retirement phase in this entire webinar today. So we're getting this new concept of retirement phase to help determine a fund's earnings tax exemption. So currently we refer to it being superannuation income stream benefits that are payable at a time, and that itself becomes the factor in looking at a fund's tax exemption. So now what we're going to see is a superannuation income stream will be in retirement phase at a time if a superannuation income stream is payable from it at the time. So that is important because when we look at retirement phase, what is in retirement phase is a superannuation income stream will be in retirement phase if it is a superannuation income stream that is payable from it at that time. So it's looking specifically at the relevant conditions of release here around retirement, terminal medical conditions, permanent incapacity, attaining age 65. Those matters there that are going to be in section 30780 are going to mean that the benefits move into retirement phase. But a superannuation income stream will not be in retirement phase if it is a TRIS or similar, so a TRAP or a TRIP or a non-commutable allocated pension, those sort of post-20 September transition to retirement income streams, and or a fund that has failed to comply with a commutation authority being given by the Commissioner in respect to the transfer balance cap measure. So TRIS is going to be specifically prohibited because of the way it's defined in Part 6 of the SIS regs, and those items there are specifically carved out in Section 30780, subsection 3. So that's where we're getting the distinction between TRIS, the tax exemption as it relates to transition to retirement income streams, because they won't be caught into the retirement phase that is eligible for tax exemption, versus those pensions that will be payable in retirement phase where a member has met a specific condition as release as set out on the bottom left-hand side of the page. So I did touch on before, to improve the integrity of the superannuation system, from 1 July 2017, the government is removing Reg 995103 from the income tax assessment regulations. So it is a straight repeal. It's gone, and it is going to have far more significant consequences than just the rationale that has been put forward around transition to retirement. We touched on it before around the obligations for minimum pensions. I also touched on it around the impact it might have for in-specie pension payments as well. So there might need to be a little bit more water to go under the bridge here, but this provides a unique opportunity in the current year to be able to use that with clients as well. And the other one that I mentioned was the limiting the use of segregation. So we're seeing a new definition being introduced into the Income Tax Assessment Act, and if basically a complying fund is covered under this definition in 295.387, the fund will be prohibited from actually using the segregated method for determining a fund's tax exemption. And the regulation is referring to it as disregarded small assets. So it relates to a self-managed fund as defined within Section 17A and B. At any time, there was at least one interest in the fund in retirement phase, and just before the start of the income year, the person had a superannuation balance of greater than 1.6, and the person in retirement phase was a recipient of the superannuation income stream, and at any time in that year, that person had an interest in the fund. Now, it doesn't mean that we can start splitting these out into different funds to say, well, no, we can use it because we've got a bit in there and a bit in there. They've made quite clear it doesn't require a person to be receiving a pension from that fund to be excluded from using the segregated method. Remember, has a balance in excess of 1.6 and is in receipt of a superannuation income stream anywhere, the fund just becomes ineligible. So again, they've been right on top of how individuals might want to look to segregation to really start loading up. And the basis for this is because they see a view that individuals will cycle investments in and out of pension phase to enable them to take advantage of the tax exemption and selling assets in pension phase versus accumulation. So what does this all mean, I guess? And that's really where I want to finish today, because there are some pretty fundamental changes in here that not only we all need to get across, but then it needs to translate into the advice and strategies that we see with our clients. So some issues, opportunities here. We are going to now, I think it's quite clear, we're going to need to have a look at deeds post-retirement. We're going to have to look at that because we can start pensions ordinarily, but they're going to be pensions moving into retirement phase to accommodate those new regulations. We're going to need to look at and understand with clients around pension reviews and what we need to do in the context of the $1.6 million balance transfer cap. What pensions might be commuted? Are we going to take out a super? Are we going to leave it in? And why are we going to do those things? We need to look at and understand the impact of reversionary income streams for clients. Do we continue with them? Do we change them? What do we do in respect to that? We need to assess our transition to retirement income stream clients as well. We need to look at segregation strategies, whether we need to peel some back, look at them specifically. We need to also look at CGT relief and look at the benefit, I guess, of taking advantage of potentially resetting cost bases for some or all of our post-retirement clients, and then ultimately revisit the role of super more broadly in estate planning as well. So today I've basically just given you as much information as I can around these. We're spending time on our SMSF events around the country between the 8th and the 15th of November. We will be going through the strategies that you need to look at and understand what the opportunities are inside your business off the back of these changes. We're probably going to do a slight change to the day now, given the depth of the pension things. We'll probably scale back some of the LRBA things so that we can really drill down and look at what the opportunities and issues are and set up really a framework for you for the second half of the year to get back to your clients and really engage with them. And ultimately what I want you to do is to make sure that you have one of the best years you've ever had in your SMSF business, because these opportunities don't actually come around. So we are right at the back end of our early bird. Anyone today online, you have until the end of this week. If you also include that promo code Tranche 2, lowercase, no space between the E and the 2, you'll be able to get it for not $497 but $440, so $400 plus GST. So like I said, it is available only until the end of this week, and then we're going to the full price of the tickets. So Melbourne, Sydney, Brisbane, Adelaide and Perth. We have the dates and locations on the SMSF website, so you can go to smsfday.com.au to purchase tickets there. And if you've got any other questions, feel free to reach out to me. So thank you all for being a part of today. We are just a little bit over time, and we've got a ton of questions here as well. So if you're prepared to hang around, I'm happy for a little while to answer some of those. But other than that, I'm going to sign off. And again, I hope to see you at one of our events in the near future. And again, if you've got any further questions, please feel free to reach out to me. Cheers.